The following is a sample interview recorded for PrivateEquity.com radio and the Certified Private Equity Professional CPEP Certificate Program. To download the full interview and unlock other benefits for private equity professionals, become a Platinum member of PrivateEquity.com.
Hello, this is Richard Wilson, and today we have with us Bradley Fisher of Featherstone Holdings. Bradley has over 28 years of experience and over 9 years specifically of working with family offices directly. Really invited him to do this recorded phone interview today for a few reasons. The first reason is to kind of dig into private equity industry information, best practices, standards, how private equity kind of works, and then also look a little bit about how wealth management firms and family offices and other types of investors use private equity and why they like to invest in private equity, so that people listening to this, if they feel like private equity is somewhat of a blind spot on their radar, either as a career professional or investor, I think this will really help. So Brad, thanks for joining us here on the phone today.
My pleasure, Richard. Thank you for having me.
Great. So let's start out with just some of the really basics. Can you explain, how private equity investments in general are kind of structured, or kind of how the business model works at a really high level?
Well, of course, there are two ways of approaching private equity. One is to invest in private equity funds, and one is to invest in direct operating businesses, either as an angel investor or as someone more involved in active management of the company. So we'll take a look briefly at both of those. Before we do that, I think we should calibrate our definition of private equity. When I speak of private equity, and when our firm Featherstone Holdings talks about private equity, we mean the full spectrum from very early investing through the venture capital space and into the buyout space, and finally mezzanine finance and project finance at the far end of the spectrum of the most developed businesses. So we're really looking at venture capital, buyout, and project finance. Does that make sense, Richard?
Yes, I think that makes sense. And from the perspective of people who are taking some of our training programs, I think probably 80% of them look at private equity as investing within private equity funds of many different types. There are some people who directly invest in private companies, and they kind of act as if they're their own, private equity fund in a way. But for this interview, maybe just because of time constraints, maybe we can zero in within the overall private equity niche to that side of things where people are investing in private equity funds, and somebody is out there and they're running a private equity fund and they're offering that to different types of investors. Does that make sense?
Yeah, sure,
Okay.
it does. What I'd like to do is just sort of focus for a second on the role of private equity in a family's portfolio, just to make sure that we're clear on that. And then certainly we can focus more on the fund side than on the direct investment side.
Sure.
So if you look at a family, especially what we call a multi-generational family, of course, all families by definition are multi-generational, but what we mean is family that has an ambition to stay together financially and in terms of the mission of the family, the organization of the family, across multiple generations. We've all heard the phrase that in America, shirt sleeves to shirt sleeves in 3 generations. The notion that grandpa and grandma have a business, they create some wealth, and then the second generation gets involved, and the third generation, and finally everybody has $12.50 left over from the initial wealth. We're not alone in America. In China, they say rice paddy to rice paddy in 3 generations, and in the Netherlands, they say clogs to clogs in 3 generations. So it's a natural dynamic that happens as the population of the family expands and the consumption of the family expands over time. The reason I go into that is because one of the things that helps families avoid that problem and extend their success together across more than just 2 or 3 generations is this close access to new wealth creation. traditional assets, by which I mean stocks and bonds, fixed income and public equities, really they generate wealth as well, but they do that primarily through compounding and through the growth of the markets over time, beta, if you will. The role that private equity investing and also real estate investing play is more along the lines of creating new wealth through entrepreneurship and through judicious investing in private assets. And so that's what we're really focused on in this conversation, and what my firm is focused on is how do we get families better access to these private investments, both on the fund side and the direct side, in order to help them build wealth and, by the way, engagement from the younger generations. Does that make sense, Richard?
Yeah, that makes sense.
So please go ahead with questions related to funds.
So could you explain a little bit about the fee structures within private equity funds? Because I think that many people, many investors are familiar with hedge fund fees and how those work, or at least a little bit more so, but private equity fees can be a little bit more confusing. Could you explain kind of how those work?
Yes, if you let's take the hedge fund fee case because it's simpler, and in many ways the private equity funds parallel those. The language is slightly different, but the idea is the same. So typically with a hedge fund, you'll have two types of fees, as you know, a management fee ranging usually from 1 to 2, sometimes up to 3.5%. I've heard some examples, but usually it's around 1 or 2%. And then what's called a performance fee, which enables the hedge fund partners to share. Often that's at 20%. That's sort of a typical norm, as you know, of the profits going forward. They'll also have what's called a high water mark, where the partnership or the general partners of the hedge fund won't make money if the profits drop below the initial point or the high level point that the investors enjoyed in the past. Well, in private equity, it's fairly similar. There is a management fee that's charged, and it too ranges usually from 1%, sometimes less, to 2%, sometimes 2.5%. I'll explain how that works in a minute. It's slightly different. And then there's what's called a carry, which is essentially a performance fee, and that's a share of the ownership of the underlying assets and the performance in those assets. So structurally, it's fairly similar. What you'll also often have in private equity and real estate investing is a hurdle rate, which doesn't generally apply in hedge funds as much, which means that there's a certain return. It's not guaranteed to the investors, but it's a rate. It's literally a hurdle that the partners of the private equity firm need to generate or need to overcome before they start to share in the profits. The carry will also range from 5 to 20% or more sometimes for these private equity firms, depending on the structure of the deal. And a hurdle rate could be anywhere from 5 to 10, 15%. Generally, it's probably between 8 and 12% hurdle rates. That means that the LPs, the limited partners, or the investors in that venture capital or buyout fund have to receive at least 8% return on their money, let's say, before the general partners of the investment fund start to share in the profits. Does that make sense, Richard?
Yeah, I think that's very helpful. That's what we are looking for. And when we started this interview, you talked about all the different types of private equity funds that can just, even when you narrow it down to, actual private equity funds that are kind of run as independent fund management operations and take outside investors. Could you maybe back up a step and kind of explain maybe the top 3 most popular types of private equity funds, so people listening to this about how the fees work and what types of investors they attract can kind of think in their head in terms of buckets of maybe the top 3 types of private equity funds that are out there in the industry?
Well, I'd say there are 2 primary types, and that are differentiated by the type investing that they do. And then there are stage differences, which I'll describe.
We hope you enjoyed the sample interview. To listen to the full interview and other private equity interviews, become a Platinum member at PrivateEquity.com or join the Certified Private Equity Professional CPEP Certificate Program. Platinum members enjoy great benefits like weekly private equity newsletters, access to networking events, webinars, interviews, and more. Visit PrivateEquity.com/association for a free 2-week trial of Platinum membership.